Okay, so in this podcast, in the course Portfolio Theory and Financial Applications, we're going to take a look at peer-to-peer lending platforms. So this is a phenomenon that has risen in popularity in recent years. And so here is the most basic structure of how some of these peer-to-peer lending platforms work. So in the middle here we have the peer-to-peer lending platform, and then we have borrowers and lenders who negotiate the terms of the loans on this platform. And the lenders then decide which loans they want to finance. But then there are also some more advanced structures here where you allow for intermediaries between the borrowers and the platform. And this is, for example, how one of the biggest platforms in this business works. And this platform is called Mintos. And so how does this work? Well, we have some borrowers who apply for loans at the credit companies, and then the credit companies can either approve or reject the borrowers, and then they decide on a number of terms here with the borrowers. And then what they do is that they can post these financing opportunities on the peer-to-peer lending platform, and then the lenders decide which of these loans that they want to finance. And they don't necessarily need to finance a whole loan, but they can come together. So many lenders can come together and finance a single loan, so that you can be invested like 10% in one particular loan, for example. And then the interest rates that the credit companies offer to the borrowers is usually different from the interest rates that are posted on this platform. And so typically, of course, the interest rate that is offered to the borrowers is much higher than the interest rate that is posted on the platform. And here there have been some good and bad examples. So, for example, in China, there were thousands of peer-to-peer lending platforms by 2016, but among those there were many frauds. And so the authorities strengthened the regulation here somewhat, but this didn't really help, because in April 2019 one of China's top peer-to-peer lending platforms collapsed, and a lot of Chinese investors suffered huge losses here. And also in the US the experience has not been too good. They've had problems with adverse selection, meaning that the borrowers that are attracted to these platforms are the ones that get rejected by their banks. So these borrowers tend to be really weak, and in the US they don't really have this culture of paying back loans as we have, for example, in Europe. So in Europe there have been some frauds, but generally the development has been stronger than in China and in the US. And in particular there are two major European platforms, Mintos, which I mentioned before, and Twino, and they are both operated out of Latvia, and they have granted billions of euros in loans through these platforms. Okay, so what are the pros and cons of investing through these platforms? So let's look at the pros first. So you get diversification across several countries. This through these big platforms such as Mintos. And you can be invested in hundreds of small shares of loans, where you invest a couple of euros in each loan, for example. And you also get high returns as compared to the bank deposit rate. So here the returns might be around 10%. And you also get a low correlation with stock returns. So these types of returns are relatively stable over time. And they often provide good interfaces where you can get good overviews of your investments. And you can also pick different investment styles, and then there are some AI implementations which will help you invest according to your investment style of choice. But then of course there are several cons. So first of all, there are multiple layers of default risk. So the creditor or borrower can default, and then the credit company can default, and finally the platform provider might also default. So there are several layers of default here. And we also have the risk of fraud, that the platform provider might be fraudulent, so that there are no actual loans behind all of this. Another thing is that the return you get is much lower than the one that the credit company gets. And so it doesn't really reflect the risk that you take. Then there are some tax issues. So you need to do some extra work when you fill in your tax form if you do all of these investments, right? So they're quite short-lived, many of these loans, and you take up maybe hundreds of loans. But on the platforms there are some tools that can help you to report what you have been doing to the tax authorities. But still, there is some extra work involved here, right? And usually it's not possible to withdraw the entire amount that you have invested right away. They have on these platforms some second-hand markets where you can sell those investments, but it's going to be hard to sell debt with late payments. For example, if the borrower has been late on the payments, then it's going to be hard to sell these loans to others right away. And now, during this pandemic, of course, there are many borrowers who default, in particular in Eastern Europe. And some credit companies have actually defaulted, and most likely there are more to come here. So there's an additional risk due to the pandemic. And then you might ask if this is socially responsible, because some of the interest rates that these credit companies charge to the borrowers are really, really high. So you could argue that you create some kind of debt trap for these borrowers. So, and you encourage people to get indebted. Also the marketing of these credit companies to the borrowers is not always that nice, right? So one might ask if this is really socially responsible to finance these types of loans when the interest rates are so high, and also the marketing strategies of these credit companies might not always be that nice. Okay, so then to summarize, the peer-to-peer lending market is growing rapidly, and there's a huge variation here in the experience of these peer-to-peer lending platforms. So in general, the European experience has been much better than that of China and the US. And investing through these peer-to-peer lending platforms offers diversification possibilities. So you have a low correlation with stocks, and it's possible to spread investments across hundreds of loans in various countries. However, the risks associated with investing through these platforms might be larger than they seem. So, for example, we have the risk of fraud. So the platform might simply be fraudulent. So they might be lying about different things. There might not even be loans backing up these kinds of things. And then there are several layers of default risk. So first of all, the borrower can default, the credit company might default, and finally also the lending platform might default. And then finally, you should keep in mind that the credit companies receive much higher interest rates than the platform investors. And this of course suggests that the platform investors' interest rates are too low in relation to the risks that they take. Okay, that was all about peer-to-peer lending platforms.